Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, March 13th, 2026, and we have a lot to cover today, Lizzie. What are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story continues to be oil's climb above $100 per barrel as tensions in the Middle East persist with disruptions to Strait of Hormuz traffic. What's particularly notable is how Bitcoin is actually outperforming traditional markets during this geopolitical stress, holding above $72,000 even as the dollar strengthens and bond yields rise. That's a significant shift from historical patterns where risk assets typically sold off during these events. We're also seeing some interesting divergence in the credit markets, with Wall Street's private credit boom facing pressure as money flows out, which has implications for banking stocks. The energy sector is getting attention beyond just the price spike, with Turkey moving toward nuclear energy diversification and questions about how this oil shock impacts Asia's petrochemicals industry. On the regulatory front, the US has launched fresh Section 301 probes into 60 economies over forced labor trade practices, and Hong Kong is planning to name and shame lawyers and auditors for sloppy IPO work, which signals tightening oversight globally.
That's quite a mix of developments. The fact that Bitcoin is holding strong while traditional markets struggle is certainly getting attention. What does this mean for traders looking at the week ahead?
For traders, the key is recognizing we're in a regime where traditional correlations are breaking down. Bitcoin's resilience suggests it's being viewed more as a geopolitical hedge, similar to gold. And JP Morgan has noted sharp flow divergence between Bitcoin and gold ETFs since the Iran conflict began. The practical implication is that portfolio diversification strategies need to account for crypto's changing role. On the equity side, the pressure on bank stocks from private credit concerns means financials could face continued headwinds, so traders might want to be selective there. The oil situation presents both opportunity and risk. Energy stocks have obvious upside if prices stay elevated, but consumer discretionary and transportation sectors face margin pressure. The regulatory probes on forced labor could impact supply chain dependent companies, particularly in retail and manufacturing. Overall, it's a market that rewards nimble positioning and close attention to geopolitical developments rather than broad beta exposure.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like from the data side?
Thanks, Robert. Earlier this week, we got several important releases that are painting an interesting picture of the economy. On Tuesday, the Consumer Price Index came in at 326.79, exactly matching the forecast of 326.79, up from the previous reading of 325.25. That's showing inflation remains persistent but not accelerating dramatically. We also saw initial jobless claims on Wednesday come in at 213,000, slightly better than the forecast of 215,000 and down from 214,000 previously, suggesting the labor market remains relatively tight. Housing data was particularly strong, with housing starts hitting 1.487 million units, well above the forecast of 1.35 million and up from 1.387 million. Building permits also showed strength at 1.404 million. Existing home sales on Monday came in at 4.09 million, beating the forecast of 3.89 million. The trade balance showed improvement, with the deficit narrowing to $54.5 billion, much better than the forecast of $66.6 billion and down significantly from $72.9 billion previously. Now looking at today's releases, we have several critical indicators. The gross domestic product report is coming out, with the previous reading at 4.4%, which would indicate the economy is still growing at a solid pace. We're also getting the Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred inflation gauge. The previous reading was at 0.4% month over month. This is crucial because it directly influences Fed policy decisions on interest rates. Consumer sentiment is another focus today, with both the Consumer Confidence Index, which previously stood at 56.6, and the University of Michigan Consumer Sentiment, also at 56.6 previously. These measures have been hovering in relatively subdued territory, reflecting ongoing consumer concerns about inflation and economic conditions. Durable goods orders are expected to show a forecast of 1.2% growth, down from the previous 1.4%, which would suggest some moderation in manufacturing demand. Finally, the JOLTS report on job openings will give us insight into labor market dynamics, with the previous reading at 6.542 million openings taken together. If today's numbers come in as expected, we're looking at an economy that's still growing, but with inflation remaining sticky and consumer sentiment challenged, which keeps the Federal Reserve in a difficult position regarding monetary policy.
That's a comprehensive look at where we stand. The persistence of inflation alongside solid growth really does keep the Fed in a tough spot. Lizzie, let's shift to our stock of the day. We're looking at MDA Space, ticker MDA. This one just completed its NYSE debut. What's your take?
Robert MDA Space is a Canadian space technology company specializing in satellite systems, robotics, and space-based surveillance solutions. They just completed their dual listing on the NYSE and Toronto Stock Exchange on March 12th, raising $300 million in a US IPO. The company operates in an attractive sector with growing government and commercial demand for satellite infrastructure and Earth observation systems. Now here's where it gets interesting and frankly concerning. The stock is currently trading at $30.80, which puts it near the bottom of its 52-week range of 30.44 to 32.13. That's a very narrow trading band of only about 5.5%, which tells us the stock hasn't gained any momentum since listing. The valuation metrics are raising red flags. We're looking at a forward PE of roughly 30.8 times with no trailing PE available, suggesting the company isn't consistently profitable yet. But here's the real issue. The analyst's consensus price target is $16.29. That represents a 47% downside from current levels, yet analysts still have a buy rating on the stock. This disconnect is highly unusual and suggests the IPO may have priced at an inflated valuation relative to fundamental analysis. The company has no dividend, which is expected for a growth stage business, but combined with the lack of profitability and the massive gap to analyst targets, this presents significant risk.
That 47% gap between current price and analyst targets is striking. What's your assessment of the opportunity here, if any?
The long-term opportunity in space infrastructure is legitimate. MDA has $300 million in fresh capital to pursue contract and R&D, and the sector benefits from increasing government spending on space-based systems in both the US and Canada. The dual listing expands their investor base and provides better liquidity. However, the risk-reward at current levels is extremely unfavorable. The near-term risks include potential selling pressure when IPO lockups expire, which typically happens 90 to 180 days post-listing. There's also execution risk on capital-intensive projects, and we're seeing this in an unfavorable macro environment with geopolitical tensions and market volatility. My recommendation is to wait. Current holders should consider taking profits given the significant downside risk to analyst targets. Prospective investors should be patient and wait for the stock to consolidate toward that $16 to $20 range before initiating positions. The first quarterly earnings report post-IPO will be critical to watch. We need to see a path to profitability, contract wins that validate the business model, and ideally some analyst target revisions that narrow this valuation gap. This could be an excellent long-term investment in space infrastructure, but timing matters, and right now the entry point appears poor. It's a clear case where buying the dip makes sense, but we're not at the dip yet. We need to see that 40 to 50% correction first to get to reasonable valuations.
Patience seems prudent there given those metrics. Let's move to crypto. Lizzie, what are you seeing in digital asset trends heading into next week?
The crypto market is showing remarkable resilience, Robert, and it's actually one of the more bullish setups we're seeing right now. Bitcoin is holding above $72,000 despite the strengthening dollar and rising bond yields, which historically would have pressured crypto. The key theme is Bitcoin passing, what analysts are calling a geopolitical stress test. While traditional risk assets are selling off on Middle East tensions, Bitcoin is being viewed more as a geopolitical hedge, similar to gold. There's an extremely precise macro signal that some analysts believe puts the $100,000 price target back in play for Bitcoin. The sentiment is bullish, with institutional interest remaining strong. However, there are some caution flags. Funding rates have flipped negative, which suggests bears might be getting overconfident and could set up a squeeze higher. There's also concern about what happens to Bitcoin if private credit markets face serious stress, given the current exodus of money from Wall Street's private credit boom. For Ethereum, we're seeing strong institutional adoption with BlackRock's new staked Ethereum ETF recording over 15.5 million in trading volume on its debut. Anchorage Digital has partnered with Puffer Finance to offer institutional Ethereum restaking services, which expands the utility of staked ETH. The sentiment for Ethereum is bullish, though CryptoQuant has warned about an adoption paradox that could potentially push ETH down to $1,500 if network usage doesn't keep pace with expectations. Currently, Ethereum is holding above $2,100, and the question is whether that level holds as support for Solana. The outlook remains positive with continued ecosystem development. Polychain just backed a $10 million raise for Very AI, which is building a palm scan identity system on Solana. The key factors to watch next week are how Bitcoin responds if it tests that $70,000 support level, whether Ethereum can maintain momentum above $2,000 with the new ETF flows and any developments in regulatory clarity. The institutional versus retail dynamic in Bitcoin is shifting, with institutions showing more conviction while some retail traders are turning bearish based on those negative funding rates. Overall, the trend for next week leans bullish for all three, but traders should watch for volatility around key support levels.
Appreciate that comprehensive crypto update, Lizzie. Well, that wraps up today's Morning Bell. We've covered a lot of ground, from geopolitical tensions and oil markets to economic data, MDA Space's challenging valuation picture, and crypto's resilience. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. I'm Robert, thanks for listening, and we'll see you on Monday.